Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So thank you for joining the session. I would like to begin with a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and this will confirm that everything is working just fine. Hello, Apollo, and thank you. Thank you for joining the session. So let's start right away. First things first, we know that today is Tuesday, so it's a short week for those who took an Easter break. I hope that you enjoyed your holiday. So there's quite a number of things happening this week. And the most important one is the US Consumer Price Index or inflation data. So hello, Regan, and thank you for joining the session. I'm seeing a comment here. Were you available yesterday? No, yesterday was a public holiday, so I took a small break. And also, I'll be away from next week. So I'll have someone stand in. So we will be having Samson Zera run these sessions. He's a great guy with a great understanding of the markets. So it will be a plus for you guys getting to hear from a different person and also getting to understand insights from another person. However, this week we are together. So let's see what we can do this week. So as I mentioned, there's quite a number of things that you're expecting in the markets this week, with the key highlight being the US CPI data or inflation data, which has been the key focus for the Federal Reserve Bank of the US this year as well as last year. So let's take a quick look at the economic calendar here. So in the morning at the market snapshot series, we covered the key events that we're expecting to be happening in the markets this week. But then on this particular session, I want us to focus on just one data point, and these will be happening tomorrow, and that is the US CPI. So for the US CPI, in the previous reading, it was a gain of 0.4%. We expect this to slow down to 0.2%, that is in March. So the previous outcome was a 6% annual inflation in the US, and we expect this to slow down to 5.2%, whereas core CPI, which is the consumer price index without fuel and energy prices, food and energy prices, it's expected to go up by 0.4%. So this is arguably the most anticipated news of the week, mainly because it has a big impact on the decisions that the Fed will make on its next meeting in May. So that being mentioned, let's take a quick look at some of the data that we have. The first chart that we have here is the United States inflation rate. So as you can see, inflation was relatively low in 2019 through to 2020, somewhere around the 2% target. So this was well within limits. However, in 2021, the inflation started rising as a result of the excessive amount of money that was printed by the Fed during COVID in 2020. So it started taking effect a year later, and prices were skyrocketing. So they kept going up, and towards the end of 2021, inflation was around 7.6%. Then in 2022, this is when the Fed shifted its focus and decided that its prime job is no longer maintaining full employment in the US, but rather controlling the rising inflation and getting it back towards the 2% target. So by the time they were doing this, around March, inflation was slightly above 8%, and they have had quite a turnaround all the way down to the current level. In the previous month, it was reading 6%. So for the entire of last year, since March, US inflation rose from a limit of 0.25% to the current level of 5%. So we have had consecutive rate hikes. At first, the Fed went for a 50 basis point hike. Then it went to 75 basis point hike, did that 4 times. Then it went for a 50 basis point hike, and then 25 basis point hike twice. So these eventually led to 6% inflation. Then from here, we're expecting this curve to continue going back down towards the 2% level. So in order for this inflation to get back to the 2% level, the Fed has committed and has dedicated its policy to tightening. So they are saying that the interest rates will have to keep going higher and stay high for longer until this curve gets back to 2%. So when you look at the interest rates and how they have been going, this is a 5-year look. As you can see, there was a time interest rates were ranging around 2.5%, and that is back in 2019. If you look at a 10-year look, then you can see that interest rates have been suppressed for quite a period of time, way below 2.5%, and most of the time playing around zero. And this has had a big impact. So looking at a 25-year chart, you can see that the last time that interest rates were this high was during the 2007-2008 global financial crisis. This is when we had inflation, interest rates at around 5%. And now the market, the interest rates have been hiked all the way back to the same level. Also back into the 2000s, when we had the dot-com crisis, interest rates were really high at around 7.5%, 7.0%. So what this means is that when interest rates are very high, credit becomes very expensive and money is basically pulled out of the system. And the way this is done is basically by people paying more interest on their debt, so they are left with less money to spend. Also, you get to see people borrowing less since the interest rates are high, and thus has the effect of pulling money out of the system. However, this doesn't come free of charge. It also has other implications. One of the implications that you have seen this time is commercial banks collapsing since they lent too much money to the government and they could not liquidate that at a loss, forcing the Fed to create what we call a BTFP program, where it's now lending money to these banks at a short-term period of 1 year. And with this money flowing to the banks, now they're able to weather the high interest rate environment. But then consequently, these banks are resulting to lending less since their financial books are not very healthy. So there are also lingering risks in the commercial real estate sector, where mortgages have become very expensive and the rates of defaults are rising, and analysts are basically speculating that we could be having a bigger crisis in commercial real estate, especially if more and more people continue defaulting their mortgages. So with this in mind, now it's time we look at the federal funds rate. Not Fed balance sheet. So as you can see, the Fed balance sheet expanded most in 2020 when there was excessive printing of money. And through 2021, it kept going up steadily. And then when we got to 2022, that is last year, when the Fed started tightening, then we had this movement back downwards in the Fed balance sheet. So during this period, let me use a smaller time frame, 1 year, you can see that the Fed balance sheet was somewhere top around 9 trillion, and it kept going down at all the way down to around this is 8.3 something trillion before it shot back upwards. So this big move that happened here was during the SVB crisis when Silicon Valley Bank collapsed. Then the Fed balance sheet started expanding, basically undoing all the tightening that had been done by about 50-60%. So this was crazy, and it was also worrisome. Everyone was concerned that the Fed balance sheet is expanding yet again. But then in the last meeting, that is the last Fed meeting, they implemented another rate hike of 25 basis points, which eventually led the Fed balance sheet to change direction. And as you can see now, it's seemingly going back downwards. So what this means is basically that we might continue seeing the dollar being strong. So as long as the Fed balance sheet keeps going downwards, then the dollar keeps strengthening. But then if it's moving upwards, then it's bad news for the dollar. So one more chart. We'll look at the USD index. Sorry, let's do the trading view one. So if you have any questions arising from the presentation, feel free to type that in the live comment section, and I'll be responding to those questions right away. Awesome. So now we have a chart of the dollar index. So I'm just shifting these to 5 years so that you can see the entire history. So during 2020, the dollar index was on the rise. So for those who are new to this, you should know that the dollar index is a measure of the strength of the dollar against a basket of 6 other currencies. So generally, the dollar was gaining up until March 2020 when COVID struck, and then the panic led to a sell-off, and we had the dollar losing for a couple of months. And once we got to 2021, the dollar now started gaining. So made quite some good and impressive recovery from this dip here. And then through 2022, it kept on gaining more and more and more as the Fed kept on tightening. But then at the beginning of this year, there was a speculation that the Fed would stop the rate hike cycle. And once we saw that speculation, then the dollar started losing. So remember, whenever there is a monetary tightening, the natural expectation is that the currency will start gaining. So early bets started around May 2021. They went through the entire year of 2022. This is when the dollar was so strong. It had strengthened against the other major currencies, with some of the major currencies like Japanese yen, the euro, the pound, seeing multi-year lows against the dollar. So these currencies have also begun recovering. And at the same time, we have seen their central banks being very aggressive with rate hikes, which has reversed the trend. And now the dollar has been losing this year against a basket of other major currencies. So just to put this in perspective, I also like seeing some good numbers. So let's look at these and see how these currencies have performed against the dollar. So the year-to-date performance, that is since the beginning of the year, some currencies have had some positive performance against the dollar. An example, the pound has made quite a good run, 2.84% rise. The Swiss franc has done the same. The euro has also gained against the dollar, and the Canadian dollar has gained slightly. Whereas the Japanese yen has lost, the New Zealand dollar has lost, and the Australian dollar has lost. So some of these central banks have been quite aggressive with rate hikes, especially the UK, and this has seen their currencies make a recovery against the dollar, whereas these Asian pairs have not been doing so well. So now, if you look at the month-to-date performance, that is this month, since the beginning of the month, it's a similar story. The Swiss franc, the pound, and the euro being very strong, Canadian dollar slightly high, and then Japanese yen, Australian dollar, and New Zealand dollar losing to the dollar. So if you look at the last 1 month, and this is the last 28 days, then in that particular period, the dollar has been on the losing side, especially due to what we are seeing here. This was the Fed going for this spike here. So the BTFP program increased dollar supply, weakened the dollar. And in that 1 month, we saw all these currencies making a very big gain against the US dollar, with the GBP leading the path, the euro, the CAD, the Swiss franc, the yen slightly higher, New Zealand dollar, and the Australian dollar. So now that we understand the history of the Fed decisions, interest rates versus the inflation rate, then we focus our mind on the CPI. So for the CPI year over year, just to give you another highlight here again, inflation was on the rise, but now we have had, I think, 8 consecutive months where the inflation in the US has been slowing down. So as you can see, this is 1, 2, 3, 4, 5, 6, 7, 8. So for 8 consecutive months, inflation has been dropping, but not fast enough to reverse the entire momentum towards the 2% target. So 2% target is around here. So as you can see, we are almost halfway through the journey. There's a lot more ground to cover up until we get to the 2%. So with inflation rate at 6%, we need to drop about 4% further, and that will take a lot. And from the Fed policy and what Jerome Powell has been saying, it may require hiking interest rates further, maybe to 5.25%, and then keeping them there for a long time up until inflation gets back to target. So with this kind of commitment coming from the Fed, then there is this expectation that the inflation rate could drop from the previous level of 5% and go all the way down to 5.2%. So if this happens, then it is well within expectations, but we don't expect the Fed to stop with its rate hike policy. However, if it remains high or even spikes higher than the 6%, then that will be a big problem, and the Fed might be a little bit more aggressive with the rate hikes. So with this in mind, then the focus is on the next meeting, but investors are following the data to know what the Fed will do. So with the dollar making a strong recovery on Friday and a weakness yesterday, then if you look at the charts, you'll notice something has been shaping up. So let's start with the dollar index. So the dollar index made some good run here for 3 straight days before erasing gains yesterday in the evening, and today has been going down. And this is basically the market pricing in that the dollar could be weak, especially if inflation drops as expected to 5.2% or even lower. So in this case, we are still having this challenge where the dollar is unable to break this short-term trend line. And with this in mind, if the bearish momentum continues, then it only means one thing, that other currencies will be able to rally against the dollar. So investors are tracking 2 data points. One is what the Fed might react to on its next meeting. They're also looking at the BTFP program and how much money is being pumped into the banks. So if there is excess money, which would have the overall effect of expanding the Fed balance sheet, then in that case, the dollar keeps on losing. The other thing is about the Fed ending its policy rate cycle. So we know that this cycle may not hold for long. We have seen other central banks stop their interest rate hike cycles. It started with the Bank of Canada holding interest rates at 4.5%. And most recently, we saw the Reserve Bank of Australia doing the same and maintaining and holding rates at the same level. So we're also expecting another data point. This will be Bank of Canada. As you can see, it's expected to hold rates at 4.5%. So if we continue seeing this trend, then it might catch up with the US and they stop the rate hikes. And that would imply that the dollar now starts weakening. So investors are really focused on the pivot when the rates are now beginning to go back down. But for now, the focus is whether the Fed will stop the rate hikes or whether it will continue hiking rates. So if you look at investing.com, you'll notice that there is this Fed rate monitor tool. And what it's pricing in is that on the next meeting on the 3rd of May, the Fed will go for a 25 basis point hike, and the probability is about 71.9%. So the probability for going for a 50 basis point hike, for a rate cut, in this is maintaining the same level at 5%, is currently at 28.1%. So the 2 outcomes that are largely expected is either a 25 basis point hike, which would push the limit to 5.25%, or holding rates steady at 5%, and there's still a significant probability of 28.1%. So in order to determine whether the Fed will go for a 25 basis point hike or maintain the same level, then we focus on the upcoming data, and the upcoming data is majorly the CPI data, whether inflation is moving as expected. So if it's dropping at the same rate or even faster, then the Fed might decide to hold rates steady at that level. However, a spike in interest rate, inflation may be closer to 6%, then in that case, we could be seeing a higher probability that the Fed will go for a 25 basis point hike. So now that we know that, let's look at how these might influence the markets. Sorry, I wasn't sharing that. So this is investing.com. This is the chart. So it's a Fed rate monitor calculator, which is based on CME Group 30-day Fed funds futures prices, which tends to signal the market's expectations regarding the possibility of changes to US interest rates based on Fed monetary policy. The tool allows users to calculate the likelihood of an upcoming Fed rate hike or cut. So we're expecting a 25 basis point hike, which would push interest rates to between 5% and 5.25%, and the probability is 71.9%. Holding rates steady at the current rate of 4.75 to 5 has a probability of 28.1%. So now, when we look at the charts and what we're expecting to be happening in the markets, on one side, holding rates steady would be negative for the dollar, so we'll continue seeing some further downside. But then if the Fed was to go for a 25 basis point hike, then the dollar resumes strength, breaks the trend line, and moves higher. So from what we are seeing from equities, it's a sideways momentum. As we can all see here, I would call this a range. This is a period of time where the S&P 500 has neither been going up nor down. It's just moving sideways. So in such a case, a scenario, it basically signals indecision in the market. So more data will give investors more confidence on where interest rates are headed. So remember, as long as there's a rate hikes, then the equities tend to weaken. That's why we had a bear market last year following the aggressive rate hikes by the Fed. However, if the Fed holds rate and signals a potential pivot, then in that case, we will be seeing a very strong US equity market. So it could be the same for the Dow, which has also been moving sideways. And also it could be the same for the NASDAQ, which is also moving sideways in a way. So we don't have a clear direction yet on the direction that the US equity indices are headed, but we will have a direction once we get a set of that data. So for the UK FTSE 100, we are expecting that the Bank of England will continue being aggressive with the rate hikes. And this is as a result of the high inflation environment that they are seeing. Then as a result, we will be expecting the UK 100 or the FTSE 100 to resume its bearish momentum. So we could be seeing some further downside from this one. So this pullback seems very healthy to start considering potential short selling positions once this momentum is exhausted. So as you can see, it's rising in what looks like a wedge. So if I connect my two lows here and draw my trend line, and then connect my highs, then what we are seeing in this market is potentially a rising wedge and the market falling back downwards. So this is what we have on the UK 100 index. So potentially the market dropping further downwards. So if you go to the daily chart, we had a trend line here. I just want to highlight. So our trend line seems to be occupying a path along here. And now the market is trading above that trend line. So this might be a nice short-term target, especially if the FTSE was to go back downwards. So from the 1 hour chart is how it looks like. So if you can see today we managed to close the gap and the market is moving back higher, but eventually the idea is to trade back down to 76.49 price level. So pound USD managed to break towards the upper side in the morning, has pulled back and will potentially move higher. New Zealand USD managed to break this particular trend line, and this was last week. Tempted to go down, but now we could be seeing some form of recovery. Notice how it's struggling to break this particular level here. So there was a sharp drop yesterday, market made a recovery today, another sharp drop. So my idea is to trade back upwards to 0.62518, especially betting on a weaker dollar. Euro USD found resistance here, pulled back and is now headed to retest the area again. So once it gets to 1.09276, then potentially a break towards 1.09709. So USD card made a break towards the lower side. It's now retesting the area. So as you can see, out of struggle, retesting here. So I don't think the momentum is that strong. So if the dollar resumes weakness, then we could be seeing the USD card drop further back downwards and potentially get to the bottom or to the base of this pattern around this area. So the price level is around here, 1.34113. USD yen, the dollar was being very strong, started weakening, and now it seems like the market is trapped between 133.7 to 132.89. So as for gold, we had a break here. I remember mentioning this in the morning. Market went back downwards, and now from the 15-minute chart, it seems like a signal to me. I don't know yet, I could be wrong, that the market has retested successfully. From the previous candlestick, it seems like a rejection of lower prices. And from the current candlestick, it seems like an entry by buyers. So we could be seeing the original idea play out, but not from that area, but now from this area here as we head into the New York session. So for Audi USD, similar thing, major support level was hit here on Friday and at the gap on Monday. So today, as the market pulls back downwards, we could be seeing this other level begin to play out. So for those who use the ICT concepts, then there's probably a chance that you will be trading the same level, expecting the market to move even higher. So that's it. We have already checked on these. Since we had that announcement, but by the Saudi Arabia energy minister, as well as OPEC plus countries, they are going to cut oil production, and this will be beginning on May. Oil prices jumped from $79.835 per barrel and opened the market at $85.849 per barrel. Since then, the market has been just oscillating between the two trend lines, and now we are just bouncing from the lower trend line. So remember, the idea is to trade on positive oil prices or increasing oil prices, mainly as a result of the oil output cuts by the OPEC plus nations. So in this case, I expect a strong bounce from this one, from the current level of 84.2. So maybe this is the final blow before we shoot higher. So I'm watching this level seriously to see the potential for a bull run in Brent oil prices. So let's see if there's any questions or comments from you guys. So in spite of the BTFP on interest rate parity, US is second to be Bank of New Zealand. Why is it that the DXY is weakening to currencies with lower interest parity? I think it's a mismatch in the market. Eventually, the market will catch up. The most aggressive central bank gets the lowest rates. So if you look at the rates from the major banks, let me try and share these. So this is what the major banks have been doing. So if you look at all these, the most aggressive central bank remains the Reserve Bank of New Zealand. So the Reserve Bank of New Zealand is not involved in any printing. So they are not expanding their balance sheet, whereas the Fed has been expanding its balance sheet. So since the dollar has been gaining against the New Zealand dollar, then it means that there's a potential opportunity that the market will eventually recover, and we could be seeing the New Zealand dollar being very strong against other currencies. However, it's very important to note that the inflation target for these Asian countries, mostly New Zealand and Australia, they have a higher inflation target of a range of between 1% and 3%. And at the same time, in normal economic times, they will often have higher interest rates compared to major economies such as the Eurozone, the US, and so on. So in this case, the Reserve Bank of New Zealand went for a 50 basis point hike on April 5, 2023, got their interest rates as the most aggressive central bank at 5.25%. So as a result, I expect the Reserve Bank of the New Zealand to be one of the strongest currencies in the market right now. So Fed is up at 5%, having done a 25 basis point hike. We also have 4.25% from the Bank of England, ECB lagging at 3.5%, the Reserve Bank of Australia holding rates steady at 3.6%, Bank of Canada steady at 4.5%, Bank of Japan has maintained the same stance for years since 2016 when they cut by 20 basis points and lowered their interest rates to negative 0.1%. So the weakest currency is expected on the long term to be the Bank of Japan, whereas the strongest seems to be the Reserve Bank of New Zealand. So also, China has maintained low interest rates. This is relatively very low for China at 3.65%. And with the inflation dropping below 1%, then USD CNY remains a key target trading pair. So that will be the last chart that we check for the day, USD CNH, sorry. So as you can see, the dollar has been attempting to break towards the upper side, but there is a key trend line holding here on the 1 hour chart, which the dollar has not been able to break despite its strength yesterday and also all this noise today. So at some point, I expect a big sell-off here, where the Chinese currency is expected to now start strengthening against the dollar. And we could be seeing a further drop towards the lower trend line. So it's a key decision point. Just keep watching the prices closely to see if there's any signs of entry by sellers in this particular market. And also notice that there's some form of triangle that was being formed here. So from this big swing here, this clearly seems like a triangle, and the market is almost testing the upper side of the triangle. So if it happens to reject and there is a strong entry by sellers, then the direction might be on the lower side. So there's another comment here. After watching the documentary Age of Easy Money, I'm not understanding why you say that if Fed pivots, we expect stocks to rally. Stocks are expected to rally. Like we have had quite a big bear market that has lasted an entire year. So the entire of last year, most of the S&P 500 stocks were losing. And this year, we have seen some of them making some impressive recovery, led by NVIDIA. We have seen Tesla do really well. Meta platforms has done really well. So whenever there's a big bear market, then the valuations of these stocks tend to be very low. So when the age of easy money is back, or when the Fed is back to low interest rate environment, and also using other means to increase monetary supply, then the valuation of these stocks tend to be on the upper side. So yes, in this case, I expect a strong rally in stocks if we happen to see a pivot. So last year, the Fed chair talked of fraud in asset and equity prices. That fraud has already been eliminated. The bear market that we saw last year was so huge. Stocks like Tesla are down 69% on the year. So I think that was the elimination of the fraud. But now this year, I think the valuations are really cheap and investors are considering going in. So it might be also indicated by the dollar. So when you see the dollar index weakening against other currencies, then it might be the signal that we are approaching the bottom of the bear market. So oil, I'm very bullish. I've already mentioned that. So for Brent oil, I expect a breakout towards the upper side. When we see that, then potentially we'll be seeing some further upside. So last question here, why is the DXY comprised 60% of the euro? It's majorly because a majority of the global transactions that happen are always in between the Eurozone and the US. there's just so much business that happens between the 20 countries in the Eurozone and the US. And at the same time, in terms of the world reserve currency, the dollar is not 100% the global reserve currency. So the euro also has a small share of the world reserve currency status, and a lot of transactions globally happen between the euro and other currencies, just like there's the dollar against other currencies. So that's why the euro has a much bigger weighting compared to other currencies in the basket for the DXY. So with that, I would like to thank you guys. Thank you for your time. Thank you for participating in this session. I hope you learned something today. I hope you gathered some insights and you will be able to trade from an informed perspective once we get to the CPI data tomorrow. So if you have any other questions, just prepare them in advance. We'll be having another session tomorrow at 11 a.m. on the Market Snapshot series. So just make sure to jump in on FX Pesa YouTube, and you'll find me on the session. So besides that, tomorrow is Wednesday. We will be releasing another episode of the Bullish Banter series. This is a podcast we started a couple of weeks. So far, it's gaining momentum. I hope you guys are getting out of value from this. So make sure that you check it out on our social media channels.